Pepsi stock has been trading at relatively cheap valuations, and I know a lot of investors are considering this dividend stock. But before you buy or sell Pepsi stock, here are some things in this video that I think you should know about, including the latest developments according to management's perspective on the company's performance, and also my discounted cash flow valuation model, which calculates a fair value for Pepsi stock. I think these are things that will help inform your decision making, whether you're thinking about buying or selling Pepsi stock. So let's get right into the details after a short message from my sponsor.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So Pepsi's management team highlighted an opportunity for its North America market, saying that when it comes to its North America market, we have one new layer of opportunity that's going to give us a lot of opportunities to improve our cost structure over the next 3 or 4 years. And that opportunity is the integration of its North American business. Right now, they have two large businesses, almost $30 billion each, that have been operating almost a full value chain side by side. Now, with the investments they're making in technology, the new data that they have and systems, they can start looking at those businesses in a more integrated way. And that will allow them to perform some of the value chain tasks in an integrated way. And with that, create efficiency and cost reduction, but also growth opportunities for the business in a combined way. The management team went on to say, think about how we service small stores or away from home restaurants. Think about some of those opportunities, how we lower the cost to serve. And at the same time, we can increase frequency, we can increase the time to sell. So these are some opportunities that the management teams feel like they can integrate with the two business. Remember, PepsiCo has a robust snacks division, a snack segment, and a beverage segment. So two different segments, but oftentimes these segments are serving the same channels. As the company's saying, think about grocery stores. When the company is sending a truck to these grocery stores, sometimes they're sending trucks with beverages separately from trucks with snacks. And so if they integrate these supply chains, they can make one delivery to these grocery stores with the combined segments, products and beverages and snacks simultaneously. So given these improvements, the management team expects that in the second half, they're expecting to deliver about 70% more productivity than they did in the first half of the year. Some of the Frito, which is their chip segment in the portfolio, and particularly the need to right-size the assets and some of the other fixed costs, it skews more to Frito delivering that stepped-up productivity. What they're going after is more effectiveness, and they closed 2 plants, and they're bringing the operations into other plants. So the company is utilizing some of the technology, some of the data to improve operations. And there's been a lot of technological advancements in this industry, in the supply chain industry, that PepsiCo can capitalize on to improve effectiveness and deliver better profitability for investors long term. By the way, this document I'm reading from is Pepsi's most recently completed earnings call transcript with Wall Street Analyst. I made this document available, the highlighted document, for my channel members, and you can join for less than $5 a month. You see the link in the description for all the membership benefits. Interestingly, the management team said that they have excess manufacturing capacity given the volume performance over the past couple of years. That means the company can produce more if demand were to increase, or the company can shrink that manufacturing capacity to right-size the business based on current demand. That gives the management team flexibility to adjust the business model as it sees fit. The company is also facing higher cost of goods, and consumer demand for these kinds of products, the beverages and snacks, are shrinking. They're not increasing as you might want them to increase, especially if you're a Pepsi stock investor. So the company is finding clever ways to generate more revenue and more profitability based on sales volume or sales demand from customers that's not increasing by all that much. Think about the different package sizes. And by different, I mean the company is able to sell consumers a package that has lower or I should say higher cost per ounce of whatever it is inside that package. So whether it's a beverage or whether it's a snack, they are decreasing the amount inside each package or selling you smaller package sizes at similar prices. That makes it difficult for consumers to be able to make a direct comparison and say, oh, we're getting less per dollar of value per dollar that we're paying to PepsiCo. I know my kids often complain when they buy a bag of chips, the bag of chips is like this big, and then there's only chips filled up like this much, right? And that amount has been shrinking over the years. I think there's a term for it. They're calling it shrinkflation, where companies are increasing profitability by putting in fewer and fewer amounts of whatever it is that they're selling, but selling the package at the same price or using clever ways to increase their profitability. And PepsiCo has been one of the companies that's been able to harness these kinds of efficiency improvements to generate better profitability. So the discounted cash flow valuation for PepsiCo, I calculated this business to be worth $176 per share. The current market price is $142 per share. So even after I apply a margin of safety, PepsiCo stock looks undervalued based on these current market prices. And you can understand why PepsiCo stock is out of favor with investors. The company is not generating very strong growth at low single digits. If you're lucky, is what you can expect from PepsiCo as a long-term investor. The profits are coming in at rates faster than the revenue growth, and that's the benefit of this business model is profits come in. If revenue grows at 3%, profits will probably grow at 6% or more because of the fixed operating leverage and how the company benefits from economies in scale. But Pepsi's not going to double your money overnight, so investors are not looking at this kind of stock as something that's exciting for investment. But I think it's something that you can add to your portfolio, and if you hold it for 10, 20, 30 years, the price is likely to be much higher 10, 20, 30 years from now than where it is today. Even if it doesn't double overnight or it doesn't double in a year, over the longer term, the price is likely to be higher than where it is today. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.